Hello, this is Eric de Carbonell from MarketSkeptics.com. As I was reading Tyler's article on Zero Hedge about my last video, I was reminded of something that's been bothering me for a while. That is, the story of AIGFP. Anyone who's read about the financial crisis knows how AIG Financial Products Unit sold hundreds of billions in credit default swaps, which helped bring the financial system to its knees. Those who've read a lot more about the financial crisis know that there were a lot of additional issues with those credit default swaps, including the question of whether they were real to begin with. All this, while important, ignores what AIGFP was doing in commodity markets. AIG Financial Products has been a key player in developing commodities as an asset class and has been active in this space since 1991. AIG Financial Products helped spearhead the rapid growth of commodity-based investments in recent years. As Wikipedia explains, in 2003, AIGFP created the Dow Jones AIG Commodity Index, a leading commodity benchmark. I actually stumbled on AIG's commodity index by chance. In February 2009, one of the readers of my blog sent me this prospectus, asking me if it was safe. And immediately something jumped out at me. AIGA is backed by matching commodity contracts purchased from AIG Financial Products Corp. I hadn't realized that AIGFP was in the business of selling commodity IOUs. Turns out that AIGA is just one of many commodity ETFs backed by AIG. So what happened to all these commodity ETFs that had AIG as a counterparty? Well, they got a facelift. UBS bought AIG's commodity index business. The transaction was sealed in May 2009, and so the Dow Jones AIG Commodity Index became the Dow Jones UBS Commodity Index. And here's the updated prospectus, with two minor changes. One is the new name, and two is the counterparty info. AIGA is backed by matching commodity contracts purchased from commodity contract counterparties. I wonder how many investors know that commodity contract counterparties means AIG's Financial Products Unit. And it wasn't just ETFs that AIGFP was involved with. Here's an article from June 2006 about retail investors piling into a new class of mutual fund that tracks commodity indexes. These funds generally do not invest directly in futures. Instead, they use over-the-counter derivatives based on commodity indexes. The two most commonly used are the Goldman Sachs Commodity Index and the Dow Jones AIG Commodity Index. The major derivative dealers, such as AIG Financial Products, sell over-the-counter commodity-linked derivatives to mutual funds. Now let's have a look at one of those mutual funds. PIMCO joined the trend in 2002 and launched the Commodity Real Return Strategy Fund. Let's have a look at this fund. The first thing to notice about PIMCO's commodity fund is that its entire portfolio is in cash and bonds. Specifically, the majority of its portfolio is in treasury debt. Incidentally, I'd heard that PIMCO has been selling off U.S. Treasuries. I'll believe that when I see that. So how does this commodity fund work if most of its assets are in cash and bonds, which have nothing to do with commodities? Well, these mutual funds use derivatives to gain their exposures to commodities, which allows them to put all their cash into treasury bills. You'd be amazed at how many investment strategies out there involve putting your entire portfolio into treasuries. So, what type of derivative is PIMCO's Commodity Real Return Strategy Fund using? It's using structured notes. The fund's strategy is to gain exposure to commodity markets primarily through investments in commodity index-linked notes, which are derivative debt instruments linked to the performance of commodity indexes. These commodity index-linked notes are sometimes referred to as structured notes. And while this might sound complicated, they are essentially the same thing as the Treasury's TIPS securities. Instead of going up or down with the consumer price index, PIMCO's structured notes use the index created by AIGFP. Now, who, besides the U.S. government, would be crazy enough to issue long-term bonds that go up with inflation? AIGFP, of course. AIGFP uses the proceeds from the issuance of notes and bonds to invest in a diversified portfolio. AIGFP's notes and bonds include structured debt instruments whose payments are linked to one or more financial indexes, such as a commodity index. In other words, AIGFP sold commodity-linked structured notes. So how safe are these structured notes? Typically, structured notes are unsecured, which puts the buyer at risk if issuers go bankrupt. For example, the bankruptcy of Lehman Brothers left buyers unable to recoup their capital. The point of this video is 1. That AIGFP sold a lot of commodity-linked structured notes and other commodity derivatives. As a result, the government inherited a huge short position in commodities. As of March 25th, assets totaling $77 billion track the Dow Jones UBS commodity indexes. 2. Unlike with AIG's credit default swaps, this open short position in commodities is unresolved. The damage has yet to be felt. 3. There are a lot of risky investments out there. If the Treasury market collapses, the US Treasury will not be in a position to backstop AIG's commodity derivatives. So something like PIMCO's commodity fund or any of these AIG ETFs is likely not going to be worth much.